Beware these products when entering retirement. As you approach retirement, choosing the right financial products can be critical to ensuring your savings last and support your lifestyle. While products like annuities, certificates of deposits, or CDs, variable life insurance policies, private deals, and mutual funds are advantageous in specific situations, they often come with significant drawbacks that make them potentially unsuitable for many retirees like you. Let's explore the use cases for these products, why they may not be ideal, and alternative strategies that may be better options. Let's start with annuities. Annuities primarily serve to provide guaranteed income to cover essential expenses such as housing or healthcare. This income can be used to ensure a minimum dignity floor. This can offer peace of mind and income stability. However, annuities are often illiquid, locking up your capital for years and even decades, with steep penalties or for early withdrawal. They frequently come with high commissions, which can erode returns, and many cap growth potential through restrictive terms, limiting your ability to benefit from market gains. And additionally, their complexity can make it difficult to fully understand fees, surrender charges, and performance constraints. Most retirees already receive stable income from a corporate pension and or Social Security. Therefore, for many retirees, an appropriately risked portfolio promoting liquidity, inflation protection, and greater flexibility is a better choice. Now let's talk about certificates of deposits, also known as CDs. CDs are often marked as safe investments, offering fixed income rates comparable to treasury bills or notes, and they can be useful for short-term saving goals or as a low-risk component of a portfolio. However, CDs are typically illiquid. They trigger penalties on early withdrawals, which can eat into your return. While public market fixed income securities bounce around, you can often find similar safety with better liquidity and comparable rates, often making CDs less appealing for retirees wanting access to their funds. Next on the list is variable life insurance policies. Variable life insurance policies can serve specific estate planning needs, such as covering estate taxes, creating tax-free growth, and providing liquidity to a beneficiary. For the subset of retirees with complex financial situations, these policies may offer superior advantages. However, they tend to be expensive, with high premiums, administration fees, and investment management costs that can diminish returns. Their complexity, combining insurance and investment components, can obscure true costs and risks, making them difficult to evaluate. Additionally, these policies are highly illiquid, often requiring years of premium payments before any value can even be accessed. For the majority of retirees, a balanced investment portfolio tailored to their risk tolerance is simpler, more cost-effective, and provides growth potential without the restrictive nature of life insurance products. Private deals. Private deals, such as investments in private equity or real estate ventures, can offer access to unique opportunities, potentially increasing risk for higher returns or providing exposure to non-public assets. For some investors, these deals may diversify holdings and enhance returns. However, private investments are often highly illiquid, requiring long holding periods. They typically carry high fees, including management and performance fees. While our team has a handful of private deals that we invest in, there are thousands of options available. In our opinion, not enough advisors or investors partake in sufficient due diligence that goes into the risk return of these deals and the suitability of the deal for each client. Let's talk about mutual funds. Mutual funds can provide access to specialized strategies that are difficult to replicate through other vehicles. They were once a cornerstone of diversified investing, but their drawbacks often outweigh their benefits in today's markets. Many mutual funds carry high expense ratios, including management fees and sales loads, and can be very tax inefficient compared to alternatives. The rise of exchange-traded funds, or ETFs, has largely replaced mutual funds, offering lower costs, greater liquidity, and intraday trading flexibility. While some strategies, which can be a great addition to a portfolio, are only available in a mutual fund wrapper, most strategies and exposures are now available through better vehicles, such as ETFs and individual securities. So to sum it up, a smarter approach for retirement. For retirees with sizable accounts, constructing a portfolio with individual stocks and fixed income securities can offer greater control, transparency, and flexibility. These assets allow for tailored risk management and income generation without the high fees or illiquidity of the products mentioned above. ETFs are particularly effective for gaining passive exposure to hard to trade markets, such as international equities, at a lower cost than mutual funds. As a retiree, your goals are not to run out of money, have liquidity when you need it, and have flexibility to change your strategy when it is advantageous to you. And in conclusion, while annuities, CDs, variable life insurance, private deals, and mutual funds have their place, they should be used sparingly in retirement planning. Their common pitfalls, illiquidity, high costs, complexity, and limited growth potential can hinder your ability to maintain financial flexibility and meet long-term goals. By focusing on liquid, cost-effective, and transparent investments like individual securities and ETFs, retirees can build portfolios designed to balance growth, income, and accessibility. Thanks for your time.